All right, so now we're recording. Welcome to Market Makers Mastermind on April 2nd of 2025. We're going to dive right in. So if this is your first time joining us, these take about an hour. We will stay on longer if we're mid-conversation or we're getting a lot of value for everybody. It's optional to hang out. We do record these, so the YouTube channel should be up and live here shortly, where we're going to have these on the YouTube channel. We're going to post the Facebook group as well, so that you can interact with each other. And that Facebook group where basically these conversations will continue offline, and these interactions will happen offline. And that's for the benefit of the community. So if you guys have referrals, if you have deals you're working on, if you have best practices you want to share, this is really for the community. It's not just for us to be talking heads the whole time. So the real value in doing these, unlike a lot of the trainings that we see online, it's not just an authority person or a figure in the front of the room just talking. We want this to be more of a discussion and just a sharing within the community. That's really the emphasis and the focus of these. So like I said, we record all of them. So if you happen to have to jump on earlier or you couldn't make one, you can always watch it over. We'll have that posted. And I also text everybody the link to watch the recording as well.
So, and guys, you can check in the show notes if you're here live or in the conversation. The Facebook group link is there for those of you looking for listening to the recording. It's Market Makers Real Estate Mastermind, and look for a link in the show notes here.
Yeah, and so if you have any questions, guys, on your little control panel for the web conference, you'll see a little hand icon right here. When we get to the discussions, which we'll get to very quickly, that hand icon is how you can get our attention, so we can call on you if you have a question or you want to share, you have a case study, then that's how we contribute and address you in the room. Okay, and we usually get to that towards the second half of these discussions. If you have any question about where that hand icon is, just let us know in the chat. So while we're waiting, by the way, just for the benefit of everybody in the group, in case anybody happens to live close to somebody else and you physically want to meet up or you have ways to help each other's business, go ahead in the chat window. Just let us know who you are and where you're operating from. 3 things: who you are, where you're operating from, and are you focused as an investor on this call, or what's your role? Are you an agent, or are you both? Right? So agent, investor, or both. Your name, location, and your role. Who we are generally is we're just a community of licensed agents. We're real estate investors as well, a lot of us. And we prioritize lifestyle over everything else. We do what's best for both parties involved in the transaction. So spiritually speaking, we do what's right and what's best for the parties involved, right? So the other philosophy that we have as licensed professionals, by the way, and even as real estate investors, is why compete when you can just find a little pond somewhere where nobody has their lines in the water and you can monopolize and dominate that space. So we're really forward thinking. We're trying to look at other signals, which we will all share on this call. I know the facilitators of this call, me, Chad, and RH, we're always paying attention to what signals are out there. Like, for example, in the market right now, if you're just myopic and you're focused on the 200 feet of headlights in front of us, and you're just looking at real estate signals, you might not see the fact that there is this private equity bubble that's happening that is dwarfing what we saw with the real estate mortgage bubble in 2008, right? And so we're paying attention to these macro signals that will indirectly affect real estate and how we play this market, both as licensed professionals and as investors. So those are some of the perspectives that you're going to hear when you come on these phone calls, is we want to zoom out so that we don't get sidelined or trucked because like I did in 2008, because I was not watching macro signals. I had the blinders on and I thought things would be good, and they were good until they weren't. And then I had my ass handed to me. So I started to pay attention to other professionals in the business, my friends who were selling everything that they had in 2006 and 2005. They were selling their mortgage businesses. They were divesting. They were closing out their funds. And I was thinking, why would you be doing that? Everything's so great, until it wasn't. And so
the same reason Gary Keller and Warren Buffett are selling their real estate brands right now.
Yeah, and Buffett is more liquid than he's ever been as far as his cash position, hundreds of billions of dollars, right, in cash. because he's ready for the impending crisis. And even Charlie Munger was saying, you look at the incentives. You heard Charlie Munger's famous quote, "Show me the incentives, I'll show you the behavior." Well, if you look at all the incentives behind private equity companies buying a Red Lobster, selling off all of the real estate, and then pretty much hollowing out that company for fees and money that is adjustable rate, that crisis, that debt crisis, that debt bubble is twice as big than the residential mortgage bubble that we saw in 2008. So we see definitely some pain on the wall, and there's a way to play that, right? So it's not bad news. It's only bad news if you're on the wrong side of that wealth transfer. So our goal is to be on the right side of that wealth transfer by paying attention to signals that we can benefit from. And again, our philosophy when it comes to relationships and everything is that it's all about the relationships. I mean, that's how we learn, really. If you think about how you learn and you go back to anything that you've ever mastered in your life, it's because I don't care if it was basket weaving or playing an instrument or learning how to code or learning AI or learning how to do real estate investing. There was typically one pivotal relationship that you had that cut the learning curve in half for you, because they are pointing you to resources and guidance and so forth. So that's what this community is about. Everybody on this call has a very special discipline that we're uniquely gifted to help the public with. And by just getting to know each other in this community and sharing best practices, we hopefully glean a lot of that wisdom from each other and can then apply that. So that's really what this is all about. Just hundreds of minds as opposed to one mind sharing one perspective. It's all of us contributing. So I'm not going to talk too much about who we are on this phone call. If you don't happen to know who we are, we've have backgrounds transacting as real estate professionals, thousands of transactions, also in property management, capital formation, real estate development. We pretty much touch all aspects of residential real estate. And we don't share that to impress you, but to impress upon you that when it comes to facilitating, extracting from all of us in this community, some of these best practices and ideas, that's really what this is doing. How this background serves us is to help us pull from this community as much value as possible for all of us to benefit from. So with that, we're going to jump right into it. Last week, who was on the call last week? By show of hands, if you guys want to use the hand button, right? So if you were here last week, we talked about demoing today and then giving away a loan wrap calculator. If you're someone who's around me on the creative finance front, you guys have this tool already. So we're going to break down the owner finance calculator, the loan wrap calculator here in a second. Before I get into that, by the way, if you happen to have a mortgage statement of a property and you're the listing agent and it's not selling, and you want to run the numbers on what the terms might look like for a buyer, how you would publish that on the MLS, for example, then just raise your hand, let us know in the chat that you have one, and then we'll call on you. And then we'll actually live demo that, and we'll keep your client's information private and their address private, obviously, as well. And if you have is it Frederico or do you go by Fred?
Fed.
Oh,
like
Fed.
Fed. Like the feds.
Okay. So Fed, if you have want to demo the owner financing on that property, there's another way to structure that we can talk about. Obviously, structuring mortgage terms on a property that's paid off is very easy to do with a mortgage calculator, but we'll talk about how to potentially structure that in a way that protects the seller more than just recording a lien on that property, right, to protect the lender. So with that, we'll talk about creative financing. But before we get into it really quick, why is owner financing important today? The obvious answer is when you have an environment where transactions are at a 40-year all-time low, which they are right now across the country. Of course, you have real estate so being such a hyper-local thing. In some pockets, it's you guys are at 2 months of supply. Like I know Southern California, you have about 2 months of supply. You don't have a supply problem in a lot of pockets of California. In Texas and in Florida and these post-COVID boom states where U-Haul trucks were just coming to us like crazy from other states, we overbuilt in our markets. And so we have a supply glut. And in some of those pockets, it's worse than others, and properties aren't selling. So when you have properties that are just sitting, the seller only has two options. I mean, if you think about it, to sell it, right? They can just lower the price, or they can throw more money at their house to improve the property. And I know some of you listing agents know how hard it is to get a seller to throw money at their property, right? So then that only leaves you with reducing the price and then bleeding out their equity over time. Well, an alternative to bleeding out your equity is just to make the property more attractive on terms. And so if you want to make a property more attractive, what's even better than just updating the kitchen in a lot of cases is make it easy for a buyer to purchase the property and save the buyer hundreds of dollars on their mortgage payments, because the seller can offer them a lower rate than they can get at the banks, right? So how many of you are sitting on listings that aren't selling, by the way, in the conversation? If you are, just kind of share with us what you're dealing with there. But yeah, so that's a lot of people on the call who are especially in Central Florida. I know this is preaching to the choir, but if you're in Central Florida and you have listings, you know this feels a lot different than it did 12 months ago, 14 months ago. So what we're seeing, I know a lot of you on this call too have already listed your properties with owner finance terms. And here's anecdotally a couple things that I'll share about that. And then we're going to dive right into the demo. Is number one, owners, if you think about the objections owners might have to finance their properties for a buyer, what are some of the objections that come to mind? There's three that come to mind that if you know how to address these three objections, and you know how to share the three benefits, I call it 3 and 3. As long as you know how to do that, we can actually help with everything else, right? So you just have to know how to broach the conversation, pique curiosity and interest, and then we can handle everything else. So literally, you're just teeing it up, and then we can help you get over the goal line and educate all parties involved and get that property closed. So the three concerns the seller's going to have, if you guys want to write this down or take notes, is number one, the obvious one is, what happens if I finance a buyer and they don't pay? Like, what is that default process, right? We'll address that here in a second. Number two is what happens if they only know, most sellers, they only know that there are 15-year mortgages and 30-year mortgages. A lot of them don't know you can have balloon payments or a maturity date for that loan, right? So if a seller has this underlying assumption that they have to wait 15 years for their equity or 30 years for the equity, it's understandable why a lot of sellers don't want to own or finance. But if you could let them know that, hey, we can put a 5-year balloon on this or a 3-year balloon period. So we're literally just providing a stepping stone for the buyer to then replace your loan with the refi later. That might be compelling enough for then a seller to want to offer owner finance and not waiting that long, right? So timing is the second issue. And then the third issue that they may have is, well, I'm going to buy another house. I need my money to buy the next house, so I can't own or finance the property. Well, is that really an issue if the down payment you get from the sale of your property is going to be enough for a down payment on your next purchase? So let's quantify and isolate that particular objection. That's sometimes not an issue when you really break down the numbers, right? So the first issue is going to be, what happens if there's a default? The way we cure a default, by the way, without getting into the weeds, is how many of you have a car loan on a vehicle you're driving right now, right? Yeah, if you got a car loan, you know you don't get title to the car until after you pay off the loan. That's how lenders on car loans are protected, because they hold title so that they can send a tow truck out to your house. I literally just saw a video short of someone in traffic. A tow truck comes up beside them at a red light, pulls up right in front, lifts up the front of the car and hauls them off with them in the car. And so when it comes to defaults, and by the way, if you want to talk about a debt crisis, there's a subprime car loan debt crisis right now, and car loans defaulting left and right. Tow truck companies can't keep up with these car repos. So we're seeing a lot of financial pain out there right now when your car is going to the bank. So the reason they have that power and they don't have to take you to court or go through the foreclosure process, which could take a long time, especially if you're in a judicial foreclosure state, is because the buyer got title at closing. Well, if you treat the financing on a house the same way you do with a car, you just don't give the buyer the title at closing. You lockbox it, And we set up a trust structure for that. So the trust lockboxes title to the property and it protects the loan. And you have a third-party servicing company collecting the payments from the buyer and dispersing to the seller every month. So the buyer and seller never interact. You have a servicing company and the trust and the trustee protecting the loan and protecting title to the property just during the finance period. Meanwhile, the seller is going to net a lot more money in the process. We'll cover the 3 benefits here in a second. And the buyer gets to walk into home ownership and have all the advantages and benefits and control of that property, just like they would if they had title. No different than you driving around in the car, right? You're just not carrying title until the financing is done and the seller's whole. So the 3 objections, just to summarize, and this is the notes that you want to take here, the 3 and the 3. The 3 objections are, what happens if they default? Well, we got a trust structure. We're not giving them title at closing. So you have a much easier way to get the property back to cure a default. Number 2 is the timing. You don't have to wait forever. We can determine up front how long you're willing to carry the equity on your property to finance the buyer. And then number 3 is, even if you're going to buy another home right away, there's ways that we can help you buy that property. We just have to get that down payment from the buyer. And then you'll find a lot of times that what a seller might object to, they're open to it when you address those 3 issues. Those are the 3 most common ones. If you can think of others, just put it in the chat. And then the 3 benefits for the seller, now that you've addressed the misconceptions and the concerns they have, are number 1, we can net more money over time and secure a higher purchase price or a sale price. By the way, a lot of agents object. This is a misconception for the agent. I'll come back to the seller benefits. The agents a lot of times have a misconception that they won't get their full commission if the seller doesn't get their full price up front. So agents, you will make your full commission on the full sale price, but you're getting it out of the down payment that the seller's getting at closing. So from an agent,
I was going to interject there. The top objections were, I'm not going to get a full commission. I'm not going to be paid for 3 to 5 years, or this must be illegal because my broker's never heard of it.
Yeah.
And those were like, I loved calling meetings with like all parties. Like I would get both brokers in the room, seller, buyer, and then just do the transaction engineering. And everyone's like, oh my God. And then they realized it was real and everybody's needs were met and it was win-win-win all the way around the table. But I would go so far as to put them all in the same room because I love defeating those. But a lot of agents on the other side of the transaction will shy away from this because they're so well indoctrinated in a conventional system that it must be illegal, or someone would be, someone would have taught me this by now. It's easy to overcome, but that's one to look for too.
Yeah, so that's a good point. If the broker objects to it, then we just get the broker on the line. But I think it's important for people to know that at a time when interest rates are the main objection that are, number 1, causing the housing affordability crisis right now, between that and money printing, where prices are today, when you throw just normal historic mortgage rates on top of today's prices, it prices a lot of buyers out. So if you're able to do for a seller what builders are doing right now with those rate buy downs, because they buy those buy downs in bulk, right? So they can buy down rates cheaper than sellers can that we're working with. If a seller wants to compete with new construction across the street, and that's when sellers really get hurt the most, is the builders putting up the same house across the street or down the road or in the same subdivision. And why is a buyer going to purchase for the same price that house when the builder's going to give them a 4.9% rate, and with your house they got to go to the bank and pay 6.5% or 7%, right?
And we have one of those to workshop today. That's what Fed's facing.
Oh yeah, exactly. So that's the number 1 way that we're seeing right now in environment where supply is growing and properties are sitting longer in the market. It's the way that we're getting properties closed more than ever. So we have about 7 closings next month on all of these properties. Were originally listed without owner financing. We put owner finance box on the MLS as a finance term, and then within a short period of time, in some cases, it's not the magic bullet, but they were able to prevent, in a couple cases, having to short sale their house or even go to the foreclosure process. So we saved a couple of these property owners from a potential foreclosure and got them whole. And now on a property that was missing payments in one example, they're now going to show, because they're keeping their loan in place, they're going to show on-time payment history on a property that was otherwise going to foreclosure. So it like completely saved them and is now building their credit compared to the opposite, right? So it's a lot of benefits. And that brings me to a misconception a lot of agents have is,
before you jump onto that, John, let's talk about, I mean, where we are in the market cycle. Like I did the majority of these transactions 2012 through 14. And it was the market, we were coming off of a bottom then, but that meant I applied this structure on a lot of things that was currently underwater. So we would sell it for slightly above market because we knew the market was coming up, and we had appraisal provisions and stuff. But it was, one of the seller objections is, well, I need my credit. And the response there is, well, you've already done a pretty good job destroying your credit. How about we let this buyer rebuild it? And they have to come to that realization on their own. Oh, wait, I'm better off doing this transaction than not doing this transaction because I don't have, and you have to lead them into that conclusion with things like, okay, well, maybe I've misunderstood something. Can you tell me what's coming down the pike in your personal finances that will make this situation better in the future? Because it seems to me like your hole's getting deeper. And they're like, oh, so they're going to build my credit score and I don't have to make that payment? And boom, they sign. But as we see price declines, and right now we're in that, the winter of the marketplace where volumes are just frozen, but we know what's next. But as we're coming off, as we're coming into where sellers end up underwater, this is, one of the big seller benefits is actually preserving their credit rating so they can buy sooner than they would if they didn't have our help and they ended up in foreclosure.
Yeah, that's a good point. And that brings us to one misconception, a big misconception. It's the reason that less than 1% of all active listings offer owner financing. It's our fault as agents in this community, is that we have a misconception that sellers who owe money on their properties can't owner finance. And so they can owner finance of many different ways with many different structures. We're going to talk about the most simple way to do it, which is a loan wrap. And so essentially they're offering financing for a buyer that creates a loan that's bigger than their underlying loan that's in place. And they're creating a payment that comes into them every month from their buyer that's bigger than the payment on their underlying loans. They're able to arbitrage their loans. So that brings us to benefit number 2. So we'll wrap these benefits up. Benefit number 1 is they can net more money over time and command a higher price for their property. Number 2, they turn their equity. And if they don't have equity, but they have a low interest loan, or both, they can turn their equity and or low interest loan into a very passive cash flow stream. And when I say passive cash flow stream, unlike landlord income where you own rental properties and you're on the hook for taxes, insurance, HOA, maintenance, appliances when they break, evictions, pets and toilets, managing the manager, you don't have any of that as a lender. So if you sell your property, in 99% of the cases, if an owner is thinking about renting their home instead of selling their property, but you present to them the benefits of owner financing and show them the numbers of owner financing, they're going to net more money owner financing their property after they collect a big down payment. And it's truly passive income, unlike a rental property where they net less money and they adopt all the maintenance on the house still. So they create a second job for themselves, right? So
this is not something to get into. Like, don't get too deep in the weeds, but some language that I used to use that was really help people. Most people who own their home free and clear have some sort of retirement strategy. They have a 401k or annuities. And I found a way to really quickly connect those dots by saying, we're essentially going to convert your equity into an annuity and minimize taxation. And they're like, oh. And they understood that because that, the older generation, like annuities have been pitched to people for years. It's not technically an annuity, but it's an income stream for an extended amount of time with minimal taxation or no taxation. So that was a way I could get it to click for people who had some level of financial savvy or had retirement accounts. Like, what if we could convert your home equity into a personal annuity? And they were like, oh, well, that's interesting. And they hadn't thought about it in those terms.
Yeah, it's the reason that your older sellers who are on fixed incomes will not want a balloon payment. So you remember, we don't sell for our reasons, we sell for the seller's reasons. And a lot of salespeople or licensed professionals make the mistake of assuming that that seller's going to do what they would do, right? And then we impose our beliefs and our values on them. Well, what may be more relevant for an older seller, but not relevant for someone who's younger, is someone who's younger may want a 5-year balloon period because they don't want to keep their equity out there that long. They have uses for that equity. An older seller is thinking maybe, well, this money's going to sit in the bank at 0 interest, and I can make 5-6% return on my money by financing this buyer. And then from an estate planning perspective, I don't have to hand my kids a pocket full of cash they're going to blow. I can hand them, like Chad said, an annuity stream in the form of a promissory note that creates a fixed income every month that they can't blow, right? So
a sophisticated older seller is also going to take into account that if they die with that note in their name, their heirs get the step-up basis, so there is no capital gain. Like if they have an estate plan, if you're dealing with, in Florida, that's common. A lot of people here in Florida, but, like Fed, for example, in LA, I mean, you're dealing with high net worth individuals, and they may not know that. I mean, we know that from the probate world, but as long as it's under $12 million, they're protected by the step-up basis, and it's actually not taxable when they inherit that, whether it's a deed or a note.
So there are a lot of reasons that a seller may not want a balloon payment, and they just want to carry the loan out until it fully amortizes over 15 years, 20, 30 years, even 40 years. We've done some amortization schedules. So don't assume that every seller is going to want a quick balloon period and get their equity quick.
And that's where the seller interview that we shared last week, if you guys weren't on last week's call, you can check it out in the Facebook group or on YouTube. But John he prepared and shared a training as well as a seller interview sheet. And that's where that conversational format, like, why are you selling? What happens if you don't sell? Like certain questions, like lead into in a conversational way, learn about their motivations. It's not always distress. I mean, we've been talking a lot about distress here lately because that's where we're coming into and we're trying to prepare everybody. But sometimes it's just a strategic move. I have another grandkid in DC and I'm tired of LA. I've had enough of this. And, it's important to me that it's a legacy play. Like I know this home has a ton of equity and I've already paid cash for a condo in DC. So make sure you ask good personal questions when you're in your seller interview. That will really help you structure this in using the simplest language and how it benefits them.
Yeah, if you guys weren't on last week and didn't know about that giveaway, you can go to, I'm putting it in the chat right now, weekly.com/ there's the link to it right there. mmmweekly.com/questionnaire. It's a seller urgency questionnaire in the tutorial. If you guys had a chance to watch that, provide some feedback if you actually went through that. It's a giveaway. You can download the questionnaire. It's 2 pages. And there's a pretty thorough tutorial on how to use that questionnaire to guide you through the line of questioning Chad's talking about to diagnose what they're trying to do in life in general. Sometimes we get a little bit myopic and we're just trying to help them with the real estate sale, but that's very limiting when it comes to the way that we can help them if we don't understand what they're trying to do in life. The house is just a vehicle to get them to some place in life, right? So that's really what separates a market maker from somebody who is just a salesperson selling a listing or a cash offer or a subject to purchase. So coming back to the 3 benefits is the first benefit is they can net more money and then command a higher price for the sale of their property because they're offering terms as the most attractive feature. Number 2 is they turn their equity and low interest loan into an income stream that's truly passive. And then the third benefit is they're able to defer tax on potentially a big taxable gain if they have one, right? So if you don't have the home ownership exclusion yet, lived in the property 2 of the last 5 years, and Uncle Stan's going to come knocking when you sell that house because you have $100,000 gain and you got a $20,000 tax bill that year then, right? Well, if you sell or finance the property, IRS sees that you didn't realize the whole profit from the sale. You didn't put it in your pocket. You only got the down payment portion of it, and you finance the rest, and you get to defer that gain over time, over the term of the loan. So big tax benefits, especially if you're working with investors. You have a lot of investors who are older who built a portfolio and they're divesting and selling off their properties now. The first part of that conversation I have with them is, what are the tax implications of you selling these? And I want to see how much pain they associate with having to sell it and realize the gain and the full deep depreciation recapture on that sale, right? And that's a bigger motivator for those types of investors than pretty much even getting a higher price for the property is tax relief. Especially those who've already sold one, they weren't counting on or accounting for that big bill at the end of the year. And then they get whacked with a $40,000 tax bill because they realized the whole sale price that year and they've owned the property for 25 years as a rental property. The next one, they're a little bit more open to owner financing than maybe that first one.
Also, you have depreciation recapture, especially since 2020, like especially with short-term rentals where people have done cost segregation. So that looks beautiful on the front end. It looks great on a spreadsheet. But guess what happens when you sell the property? Like that bonus depreciation is reclaimed. So there's more than just the income tax implications. You also have the deferral of, cost segregation and just depreciation in general. And a lot of investors don't even account for that. They think it's just magic money that was given to them, but you pay the pound of flesh eventually.
Yeah. If you guys, by the way, a little free resource, if you look in the chat, is it costsegdiy.com or DIYcostseg.com? It's where you can do, if you have any investors who qualify to get a huge tax write-off up front for that bonus depreciation, I think it's DIYcostseg.com. You need to do a cost segregation report. Yeah, it's DIYcostseg.com. And instead of paying a tax pro thousands of dollars for that, you can actually just get that done online, especially on a single family home. It's super easy to do. DIYcostseg.com. And they can get huge. So in other words, what that allows an investor to do is a $300,000 rental purchase could turn into a $60,000 write-off that year that you purchase. I mean, it's a huge benefit for investors because there are a lot of investors out there who, to Chad's point, they'll buy the property on an even cash flow, and they're just doing it because they want to write down their adjusted gross income. Imagine if you could take $60,000 off your adjusted gross income for your last year's tax filing. That's huge for your tax liability. And there will be people who do that just for that bonus depreciation. So to do bonus depreciation, you have to cost segregate your property. In other words, you got to show the IRS that, hey, this is how much of the property is the building, how much of it is personal property, how much of it is improvements, land improvements, and then how much of it is, what am I missing? The land, right? Because you can't cost seg the land. So anyway, that's a great resource for your investors who need big write-offs and they qualify for that write-off. So then that brings us to so you got the three benefits and the three benefits and the three concerns that owners will have about seller financing. We're going to go into the owner finance calculator. And if nobody raises their hand, that if you have a recent mortgage statement for one of the listings and you want us to demo in real time what your listing looks like with a loan wrap, I'll show you that. If we don't have one, I already have one that we just recently structured and actually hooked the buyer for as soon as we structured it. Okay. So we'll break that down either way. But Federico, why don't we start with a property that's already paid off? We'll use yours as an example and we'll talk through that. And then for those of you, by the way, who have listings and you've gotten creative finance offers, how many of you have received subject to offers on properties that you have listed and you just either throw them in the trash can or, I mean, you got to present them all to the seller, right? But you either dismiss them or present them with the seller with dismissive attitude, or you don't know what they are, or you want to save face. So you maybe don't want to share it with the seller, don't know how to explain it to the seller. So you say no as your default answer. It's kind of like an attorney. If we don't understand it, a lot of times our answer is going to be no, because we don't want to open up a can of worms, right? And expose ourselves and our clients. And that's a completely normal reaction, but I'm going to show you how to counter those offers when we're done with this. Okay. So
John, we've got, just so you know, Denise and Jared, I think, have deals to put on the table when you're ready.
Okay. Do you guys have deals to put on the table, or Jared and Denise, did you raise your hand because you were agreeing with me that you're listing agents that actually have those creative finance offers?
I've gotten quite a few on mine. I haven't really looked at them because most of them have been lower. Like I've gotten cash offers and then I've got the creative financing, but I just don't know my situation, how that's going to work because she doesn't have any equity. So,
Oh, so in other words, she's not expecting to walk with any cash at closing. What's her net sheet showing that she's actually going to walk with?
well, the price I'm at right now, like $5,000.
Okay. And what's the purchase price?
It's too high. I have it
What's
at
the-
441,
Okay.
but I think it's closer to like 420 is really what it should be.
Okay. Gotcha. Did we ever talk about structuring owner financing on that one or no?
Well, I don't know if she could do owner financing because she owes the 404. I think that's what she owes.
Yeah, she still qualifies. So, and actually it could be a compelling way to get rid of that house, because you can get away with a much smaller down payment. Let me ask you this. What's the plan if she can't sell the house?
Well, it's very interesting because the lady that is living there is not on the mortgage. It's her daughter and some other girl. And they signed the listing agreement with me, but she said she can't make the payment anymore. So she told me like, I'm going to give it back to her, which I don't know what they're going to do. So I may have to call them to find out like what their plan is.
Okay. If you can get a copy of that recent mortgage, of like a recent mortgage statement,
Okay.
we can demo right here exactly how that could be financed. Because interestingly, if you have a property that has no equity and the seller's not going to net a lot at closing, and by the way, anything in markets where you have high supply right now that was purchased in the last couple of years with very little money out of pocket is going to be upside down today after you account for commissions and closing costs. So if somebody bought a property in 2023, the fall of 2023 for $500,000, properties haven't gone up in value much in the last year and a half or so, 2 years. So if you had to sell that property today, and then they had to account for anywhere from 5-6% commissions plus some closing costs, sometimes they're going to have to bring cash to closing to make the loan whole. If they don't have that cash to bring to closing because they're in a financial situation where they can't make the payments or they just don't have that money, then who has to take the haircut? The lender's going to have to take the loss, right? So that is a scenario that we're seeing a lot of with the short sale processing business. By the way, Loan Mitigation Services, a short sale processing company, we're probably have about 40 files right now that we're processing short sales on. There's a lot of property owners. A lot of those property owners are the case that we just talked about, where they bought it recently. Now they have to sell. They did FHA, USDA, or like a 5% conventional loan. And especially if the property wasn't taken care of and their dog damaged the place or something, now you have a property that 100%, they're going to have to bring cash to closing based on today's sale price, commissions, closing costs. They're not going to be able to make that loan whole with their proceeds. And if they don't have that cash, then we have to work with the lender to take the loss, right? That hit. And so that's what the short sale processing actually does. So in a couple of those scenarios, we're able to take them out of the short sale world because they had to they didn't start as a short sale because their price was up here. But then as they chase the market down and take more price reductions, like Denise, in your scenario, you said if they had to take, she's only walking with $5,000. So if you took anything more than a $5,000 price reduction, she's going to be in a short sale. It's going to be a short sale, correct?
Whoops. Yes. And also, I don't know if I told you this, she leased solar also.
Oh, okay.
So she did that like October of last year, and it's a lease, so it's like $275 a month, and I don't think you can pay it off.
Oh, so the buyer has to adopt a $275 monthly payment.
Correct.
Yeah, interestingly, at least there's not a loan on it. In other words, a lot of short sales, a lot of properties are upside down because there was a $40,000, $50,000, $60,000 solar lien attached to the house. And unfortunately, the property owners who were sold solar systems, a lot of them didn't realize that it helps your property value zero. So,
Oh, I know. Oh, well, and that's the problem. It's like that was just in October, so it's like 25 years of 275.
oh wow. So that might be a short sale if you can't get out from underneath it. But an alternative to having to go the short sale route and to take a price reduction is just what we're talking about here, is structuring owner financing on it. Now, in a situation where there's not a lot of equity or even negative equity, the down payment, since the seller's not walking with any money, the down payment is from the buyer is literally just to cover the commissions and any money that the seller has to bring to the closing. That's literally all you have to do for the down payment. And then the seller, the next question sellers will have is, when you take a small down payment, aren't you at risk of a potential default? Well, this is a no lose scenario, because even if they default, it sounds like if this property doesn't sell anyway, it's going to be heading to either a short sale or a foreclosure. Am I wrong?
Oh, correct. Yes. I mean, because they can't rent it out and cover that mortgage. The mortgage is $3,400.
Oh wow.
And,
What's the
and
rate on her loan?
I'll have to check. I can find out. It was like, I think they bought it in 22 or 23. So,
Yeah, this is a perfect example. So they must have bought it with a low down payment then, right?
oh, it was 100% financing.
Okay. Yeah. So anytime you have a scenario like that in the last couple of years, nearly 100% of those people are upside down on their properties in a market like ours right now, where you have a oversaturation and properties are sitting longer. So what's the plan on that one right now?
Well, the last time I talked to the lady that's living there, she's like, "Oh, I'm just going to give it back to the seller." And so I can call the seller maybe and get a conference call with her and just find out, like, what do you guys want to do?
Okay.
You know, maybe come up with a plan, for some way that they can get out of it. Cause it's not her credit, the one living there. It's the ones that are on the mortgage.
Yeah. So I would say, let's book a call with, if you can get a recent mortgage statement, let's come armed with that call, the recent mortgage statement, and the people who are on the mortgage.
Okay.
And have a conversation about, because plan A would be, if you're not going to do a price reduction, right? Plan A would be, let's keep it at its current price, or even just take the $5,000 deduction, right? So
Right.
not short sale territory. She's missing, how many missed payments does she have?
I don't think she's missed any yet. She just keeps telling me she doesn't think she's going to be able to make any more, but I think she made it this month, but I'll find out.
Okay. So this is a training for another time, but we don't do subject to transactions. We don't structure them for sellers. We don't buy them subject to either as buyers. So if you're in the subject to world, the reason we don't do that is we don't want to violate the mortgage contract. We're not taking strangers and exposing them to a due on sale clause potentially, or the loan getting called. There's a lot of other reasons, but we don't do subject to transactions. So if there's a loan in place, we'll just do a loan wrap. Even with no equity, we can still do a loan wrap and structure that to where they're creating a new loan for a buyer, and that payment for that loan is making the underlying loan payment. And so we can actually structure that with the loan wrap calculator. The difference is the seller just doesn't walk with anything at closing. But one thing that you have to keep in mind is the down payment from the buyer has to be enough money to cover what it costs to get it closed and get that loan current if it's behind, right? So when you sell a property with owner financing and there's no equity, so the seller's not walking with any cash, it would be no different with owner financing, right?
Okay.
But the down payment's got to be able to cover whatever the commissions would be for whatever is on the listing agreement, and or is going to cover the buyer brokerage as well. It's also got to cover any closing costs that the seller and or buyer are going to take on. And then it's also got to cover in the case of a delinquency, or if there's any loans or liens that have to be cured, it has to be able to cover that as well. So the good news with this property is you can literally put it out there for almost no down payment. I mean, literally probably 5 to 7% total to cover total cash to close of the sale price, because that'll cover the commissions. She doesn't have to cover a reinstatement amount because the loan's already current. So it doesn't have to be brought current, in other words, because usually that's part of the down payment too, to bring the loan current if she's going to leave the loan in place. So the loan's current, no reinstatement, just commissions, and maybe about $7,000, $10,000 of closing costs. Total cash to close that property. So literally someone could buy that property with very little down. And then literally we can structure a loan that matches what her underlying loan is, and then install a servicing company to collect those payments. So yeah, if you can bring a mortgage statement and bring the players who are on the mortgage involved, that would be on the hook. We'll show them that, look, your alternative to doing the owner financing is you have to come to the closing with cash if we lower the price anymore, because we're chasing the market down at this point, right?
Yes.
And if they don't have that cash, then plan A would be, let's do owner financing, check that owner finance box in the MLS, write it up in public remarks, make it look pretty attractive with that language at the very top, and then see what the market says. And then within a month, so maybe a month is the maximum time that she's covering the mortgage payment, or another month. In a month's time, if it doesn't sell with owner financing, then we go to plan B, which is let's go short sale.
Okay.
But like the first day, like in addition to MLS, go to your top 10 lender contacts and put an email out to lenders. And, you know, if you've denied anyone in the last, 30 days that's actively looking for a home, here's one that might work for them. And by the way, we'll make sure you get the refinance. We'll create a loop. The relationship will loop back around, and when their client is lendable, they're going to be the lender on it. So be sure to don't just rely on MLS, rely on your network too. I'm sure you know a ton of lenders that are currently they're worried about getting paid next year too.
What's the address on that property, Denise?
I think it's 12972 Brokefield. So it's BROAKFIELD. And that's in Orlando.
Okay, let's see. So everybody can see. Maybe we get your house sold on this phone call.
It'd be great.
Here's the property right here, guys. We can potentially structure. Now, here's the thing. It doesn't cash flow. So take the investors in your head and get rid of them. This is for an end buyer looking in the 32837 zip code. And we got a 4-bedroom, 2-bath house. Oh, it's a pool home too, Denise?
Yes. Mm-hmm.
There you go. They can literally put down about, what that going to be, probably about 35,000 total cash to close, 35 to 40,000 total cash to close, and literally take over a payment of, how much is the payment?
I think it's 3,400.
That's PITI.
I think so. Yeah.
Okay. So 3,400 a month, they take over a payment. They walk into a pool home, no credit check, no credentials, no underwriting. And we can close as quick as 2 weeks.
And it's a nice neighborhood. It's a nice area.
Yeah. So that's how we might structure something like that. But to use the loan calculator template, let's go to, I appreciate you sharing that, Denise. We'll book a consult with the mortgage holders, and then we'll present this as a plan B. We'll also talk about, this will be a plan B as opposed to taking just price reduction after price reduction. Then plan C will be the short sale. Okay. And we'll talk about that. We'll kill 2 birds with 1 stone, kind of manage expectations. Now we have a plan in place for them.
Okay. Thank you.
Yep. And then if we go to, let's talk about Fed, your property. What's the sale price on it?
1,699, 1,699,000.
Man, I have to open up all my cells for California examples because we're not used to all these digits. 1,699,000.
Yeah. Yes, sir.
I'm not used to putting 7 figures in these.
Mm-hmm.
So let me talk about the 4 ways that you counter an offer that relates to how we structure terms. Okay. So if you're a listing agent, and by the way, I'll break down what this sheet is here in a second. Okay. If you're a listing agent and you get these creative finance offers, remember the acronym. You guys want to write this down, Dr. BS. I'm going to put it in the chat. DRBS. Dr. BS is the acronym, and that's the 4 letters that stand for the 4 terms that you want to counter on these creative finance offers. So if you're getting these subject to offers, don't throw them in the trash. At least counter. It only takes 1 email to reply back to them and encounter with these 4 terms, right? So the D is the down payment. Usually these subject to offers come with almost no money out of pocket. And unless your seller's in a situation like Denise's seller where there's no equity anyway, most sellers are looking for some of their equity up front, and you want enough skin in the game for the buyer to hurt if they default and they lose their property, right? So the D is for down payment, target between 15-20% at a minimum. If you take less than 15% down, you get closer to 10 or lower. You probably want to start doing credit checks and looking at bank statements and everything to protect your seller, right? So the D is the down payment. Usually those offers come in with almost nothing down, or maybe 5% or something like that, right? If anything at all. So counter with a healthy down payment, 15 to 20%. The R is the rate. Most of these subject to offers, I mean, subject to implies I'm taking over the loan as it is. But if the seller has a 3.5% interest rate, why can't they arbitrage the capital on that loan like banks do? Banks get money at this price, and then they put it out at this price on car loans and mortgages and credit cards, right? So the seller's got this rate locked in for 30 years or 28 years or 25 more years. They can arbitrage the value of that loan. So if they have a 3.5% rate, instead of the buyer who's purchasing this subject to and taking over that payment with the 3.5% rate, why not have the seller say, no, I'll lend you a portion of the sale price after this down payment, but I want a 4.9%. So you counter with a higher rate than the underlying loan, or at a higher rate than just them taking over the loan as it is, right? So the D is the down payment, the R is the rate. The B, I might know what that B might be. The B is the balloon period. Yeah. So the balloon period on these subject to offers, usually they don't even bring one up because they want to take over the loan until it's gone, right? So that might be 25 years or 28 years. In some cases, they'll go 10 years or 15 years. They typically do longer balloon period. But if your seller wants to cash out sooner than that, then counter with a balloon period of 5 years, 7 years. Most of the ones we do, by the way, are 5 to 7 years, right? Unless the seller's in the situation like Ted and I were talking earlier, and it benefits them even more to just take it out and not even have a balloon in some cases. We were structuring one on a mobile home earlier today. It's a $125,000 mobile home, and that mobile home could rent for $1,200 a month. So instead of doing a 30-year amortization schedule to calculate the payment on the mobile home, we just did it for 15 years. And now the seller's like, well, shoot, if I can get my money in 15 years, I'll amortize this whole thing out. I'll carry it till the loan's done, right? And then we don't have to worry about a balloon. And now you're not putting a buyer at risk of being in a corner to get a refi they can't possibly get in the future, right? Say in a 5-year period or whatever. So the balloon period you want at a time that works better for your seller than maybe the buyer's offering. Remember, all these are just strings you can pull and levers you can counter, right? And then the last one is the most important one, guys. It's the structure. If you want to buy the property subject to, meaning you're trying to buy it and get better terms instead of going to the bank, we'll offer some better terms than you will get at the bank to varying degrees relating to the down payment, the interest rate, and the balloon period. But we're not going to give you title at closing. This is where the trust structure comes in. We'll spend more time on that at a different call. But we're going to treat this like a car loan, because I don't want to violate my mortgage contract as a seller and trigger the due on sale. It could jeopardize the deal for both of us. And I also don't want to have to chase you for the deed and foreclose on you as my only cure for a default. Thanks, Chad. If you look in the chat, Chad just summarized the Dr. BS. So you want to counter with the structure. So not only do I want a little bit more money down, a little bit higher rate, a balloon period that's maybe 5 years as opposed to what you're asking for, which is 10, but we're going to structure this in a way where you're not going to get the deed at closing. You still can do everything you want with the property. You still get homestead exemption, all that kind of stuff if you move in and all that, but you're not going to get the deed at closing. So similar to a car loan, you get title once you pay off the loan and satisfy the seller with your own loan, right? Or you sell the property or you pay it off at some point in the future. So just remember, Dr. BS. So in the same way, Fed, coming back to your deal here, we got a sale price. That's one lever we can pull and negotiate, right? We got the down payment. In this case, we want it at least 15% down. So let's say 20% down would be $340,000. 5% will be 170-ish. So let's say we put, you could put like a $200,000 down payment on this as like an initial proposal. If the seller feels like the buyer, if they default on this loan balance of 1.5 million here, that's the balance of the purchase price they would finance for the buyer. Then they could keep the 200,000 down and they feel good about that. Then you can use the 200,000 as down payment. This is kind of a framework, right? Obviously, when you consult with the seller, you can adjust anything in these gray boxes here. Okay. Then you're financing basically 1.5 million of a $1.7 million sale at 4.99%. So the rate that we try to land on is the sweet spot is better than the banks are offering, but higher than their underlying loan. So if their underlying loan is 3.5% and the banks are at 6.5%, we try to want to be at the 4.9, 5.9. That's kind of what's popular today, right? And if you have a mobile home that's a cheap property and the rent's $1,300 a month, and your 5% puts them at $600 a month, then you have a lot more room to even go higher than that on a cheaper property like that, right?
But in like in this scenario with Fed, like he has a retired, affluent, like unlendable client. So one of the questions when you're talking to him, Fed, is, well, where would you put $1.7 million otherwise? And at his age, it's likely he's going to be in a bond portfolio. Like he's probably doesn't have that much exposure to equities. If he does right now, he's got a foolish advisor. But if he's a sophisticated guy, he'll know bond, like risk-off assets are showing lower and lower yields because a lot more money is going risk-off in this environment. So it might look more attractive to him than putting, like if he had that cash, then he's got to move it into bonds. So at 4.99, he's likely to get a better yield doing this than he would using his bond strategy. So again, understanding where they are in life, like personally, where are they, can really help you pull these together and set the right rate that looks amazing to them.
Yeah. So Chad's basically saying that 1.5 million he's financing, if he did sell it on a traditional sale and got all that money in his pocket, what is that going to do? Just sit in the bank? What's his intention with that cash? It's on the second page of the seller urgency questionnaire, is what is your intention with the equity that you get once you close? If it's just going to sit in the bank and earn nothing, this is a great alternative.
Yeah. And for a lot of us, I mean, for most people on this call, like who would take a 4.99 yield? I sure as hell wouldn't. But we're dealing with a generation of people that came up when these products were created. So annuities and bonds and these safe retail investments are what they're likely exposed to already. So you can show them how they can outperform that. And the other thing, and on this one, he's going to break through his capital gains limits, but on lower priced assets, as long as you keep the annual gains below 49.9, there's 0% capital gains. So for someone with $150,000 asset free and clear, you can show them a long path to a tax-free disposition. Not going to work for this guy, but he'll have a $500,000 exemption.
Yeah. Fed, you had a question?
No, I was going to say, it's actually two questions within one. The first one is my guy needs this capital to close on another escrow that we're in for their new house.
Oh yeah.
So
how much does he need, by the way? The whole thing?
It's going to be the whole thing. Yeah.
Okay. So yeah. So this wouldn't work if he needs all of the cash.
Well, let's back up to last week. We didn't get an update on the brief.
Yeah,
So
for sure.
did you try a non-QM lender for him?
Not yet, because I'm also trying to speak with the builder. We kind of had a little bit of a hiccup with the builder. Essentially, builder told me yesterday that we have until Tuesday to get the house sold, or they're gonna have to cancel escrow on the acquisition.
Because
Yeah.
he's got that sale contingency in place.
Yeah, I mean we went into escrow for this house 4 times. It's been very interesting.
Man, he wants that house.
Have you offered to trade assets?
Well, the builder built the house that we're selling. It's the same builder.
Have you offered to trade the builder that one asset for another and then carry a second?
No. How would we structure that?
House A, the subject property, and then house B, the new construction. Offer a deed, a quit claim deed on house A, and then put a mortgage. It would actually be a first mortgage on house B.
What's house B price? The new construction.
1.75, wasn't it?
The new one is.
Oh no, you hammered them down to 1.65.
Yeah, yeah, yeah. The 165.
So, like, think creatively. Like, what if you can get the developer to take back a resale house and sell as a model home, and then take the difference that you're obviously going to have to pay for that privilege, but attach that to, house B.
I like that.
So his new home is actually 50,000 less than the one he's selling.
Yeah, it
Yeah,
was actually supposed to be more
That
expensive.
beat him up for 150 grand.
A little bit, yeah,
Yeah.
yeah.
So
It's good.
he could
It's fun.
pay a premium for that then, yeah.
Right.
So that's how that would look. And by the way, a risk to a lender is if the buyer defaults on their tax bill, meaning if you leave that tax bill open until the end of the year and the buyer has to come up with all that money and doesn't have the money to pay the tax bill in one lump sum, then that's a risk to the lender. That's why lenders require escrow and chop it up into 12 payments, right? And then they take over that tax bill. So in the same way, the loan servicer that we put in place, just like any loan servicer for Wells Fargo, these big banks, this loan servicer is going to collect 1/12 of the tax and insurance premium every month as well. So the buyer will pay the full tax, the full insurance premium for the full year, but then they'll take that number, divide it by 12, and then add that to his payments, as well as 1/12 of the expected tax bill too. So we put that in this box right here, whatever that monthly proration would be for tax and insurance, that gets added to the principal and interest payment, and that's your total monthly payment for the buyer, right? So that's how we use that sheet on a property that's paid off. Now, if it's not paid off, and we'll close with this, is you would put the loan balance for the underlying loan here. That's the off of the mortgage statement. You would put the tax and insurance escrow here. So whatever's on the underlying mortgage statement, you put here because that's passed on to the buyer. And then the seller is technically making a spread between the principal and interest payment that comes in on the new loan and the principal and interest portion of their payment that goes out on their underlying loan. They got that spread. So if in this, I just rewrote a deal that we're actually closing right now that sold for 570 and he owes still 363. So his equity is the difference between the 570 price and the 363. He's getting $100,000 down payment. And so the loan he's offering the buyer is 440,000, 110,000 down. I'm sorry. So the loan he's offering the buyer for 440,000 is creating a payment that gets him about $800 a month cash flow between his underlying principal and interest payment and the new loan payment. So these three cells here are involved if there's an underlying loan. If there's no underlying loan, you just use a mortgage calculator and calculate what the payment's going to be, right? And then we have a little litmus test. We put the market rent up here. So in markets where it wouldn't apply in California because you don't really buy to have a cheaper cost of ownership than cost of rent. It's way the other way around out there, right? But if you're in a market like Florida or Indianapolis or St. Louis or whatever, and the cost of rent and the cost of ownership are very similar, you can use this market rent number to kind of see, okay, based on this finance term that we're offering these buyers out there, how attractive is it, practically speaking? What's the cost of owning this house versus the cost of renting it based on these owner finance terms, right? So you can kind of see it from a buyer's perspective, how that payment looks to them. So with that, guys, we'll continue the conversation. I'm not cutting everybody off. If you want to hang out, but want to honor as closely as we can the 1 hour time frame. If you have to log off, the rest of this, we will record the whole thing. We're going to put it in the Facebook group. I'll text everybody the link where they can rewatch the whole thing as well. So appreciate you guys joining us. But with that, Fed, you had a question?
Yeah, it's I'm wondering if this could apply. So I had a couple of months ago, we went through kind of a very interesting deal. I had another client who was trying to purchase a home from a developer. So there was no loan on the asset. The property was we came to the agreement that it was $6 million. My client basically wanted to see if we could do seller financing versus going with a traditional lender. And the seller's attorney advised us to do she didn't have all the money, right? So she has a business that generates very generous cash flow every month, like upwards of 300,000 a month, but it could be anywhere from 150 to 300 grand a month, right? So the client had suggested, hey, I can give you, Mr. Seller, X at the beginning. So let's call it, I think it was 800 grand. And then I'll pay you X thousands per month. So let's call it 100 grand per month for, let's call it 5 years. And then I'll pay you a balloon payment. The seller's attorney had instead recommended for us to do a lease to purchase. A lease to purchase, and let's say out of the 100 grand, 60 grand was going to go towards the principal and 40 grand was going to go towards the rental. And so my client said, well, why am I shelling out 500 grand a year on a rent that should go all towards the either the principal? She said, I'm obviously willing to pay him a fee or some type of profit on it, but I don't want it to be 40 grand a month.
So what's the sale price of the property?
6 million.
6 million, and the buyer's willing to put 500. How much of the down payment?
800 grand. 800 grand.
So 6 million with 800,000 down, and then she wants the seller to carry the 5.2.
That's correct.
And why did I'm kind of curious if you happen to know, why did the lawyer suggest a lease option versus owner financing?
That's the only way the attorney knew how to structure it.
Asset recovery. He's got a liberal court. Like, he was looking out for his client because it's easier.
Right.
You can recover the asset in default with an eviction, not a foreclosure.
Right.
Which still isn't fun in California.
No.
Right. That too. Now
But
insurance too.
that's where, like, he felt his fiduciary responsibility was it's not the best solution for all parties, but I'm sure that was his line of thinking as a fiduciary.
Right.
Yeah, I would say Fed that if your client is the buyer, right?
Yes.
What was
yes.
the seller's response?
The seller said, let's just do what the attorney says. And my client's response to that, who ironically is also an attorney, but not from Europe, she said, look, I'm all about being fair, and I'm cool with the guy making money because he says he's essentially doing me a favor by carrying the 5.2. But that sounds really aggressive, and client don't like the fact that he could just evict me. Now, I did explain to her that California is a very tenant friendly state, and therefore evicting is not that easy. But still, it's a headache, and it's time, and it's stress, so if we can avoid it, why not, right?
Why would she be open to an interest only arrange? In other words, creating a rent payment that would look like a very attractive interest only loan. So in other words, you accomplish what they both want. I mean, you don't get around the eviction part of it, but if
Right.
you want to honor what the attorney's trying to do, and she still wants to be in a situation where if she's not going to build equity anyway, why not structure a monthly payment or rent payment that would be equivalent to what a really good interest only payment would be? In that case, you don't build equity either, but you got a great payment that beats what was the rent number they were quoting?
60 grand. 40 grand.
40 grand a month. Okay. So, if you were to do 5.2 million as an example, right? Zero down. If you're going to do a loan for 5.2 million, and you did it's never going to pay off. So you're just going to do an interest only payment. So basically they're asking for,
at 6%, it would be 312 or 26 a month interest only at 6%.
yeah. So they're basically getting equivalent to an interest only payment on 5.2 million of 9% interest. So, if you can get around the eviction part of it, I'd be kind of curious to see, hey, look, this sounds great, but I'm doing this because I want the advantages of building equity. If I'm not going to build equity, can I at least get an attractive interest only payment, a monthly payment that will be equivalent to, say, if you do 5%,
You can still give her the benefit of equity. You just have to make sure you have a tight option agreement. So if you're going to do it on terms like that, I would get an option for $1. But you essentially your strike price, like your agreed upon price. So she can build equity above that price. If the market rises, market drops, she doesn't have to exercise her option, and she can just write it off as a business expense for the rental.
Yeah. Did she propose what
Make
rate?
sure there's an option agreement in place, completely separate, not part of the lease, no term in a lease. It's a separate legal document, especially in California.
Did she mention what rate she was willing to pay?
At the time, she was willing to go up to 7%.
So
Chad, what did you say that document's called? That separate document?
An option to purchase. It's so it's an obligation to purchase for X price, or excuse me, it's a privilege to purchase for X, but not an obligation. And you're going to have a term on that, usually 2 to 5 years. And normally there's a cost because she controls the asset. Like I record the option as a memorandum of sale at the county courthouse. So
Okay.
you literally can't clear title with an option recorded against it. So if anything were to happen, if her estate held the option, like you could have the benefit of equity, but she has the downside protection that if the market corrects and that house is all of a sudden worth $5 million, she lets the option expire. You put a satisfaction or expiration on at the county courthouse and they can release it. She can do whatever. But if she was willing to eat 7% already, this is an interesting way to have her pay the same amount, but still have control of the asset until she finds alternative financing.
Okay.
yeah, her option money, at the end of the day, it's not what you own anyway. If she builds the equity she wants and she controls the asset, the option gives her control of that asset.
Right. And
But
what
what
I'm
if
saying
she-
is because you're paying a premium and you're not asking for rent credit, like which debatably is illegal anyways because of Dodd-Frank. It's a gray area depending on how you structure it. But this is a way cleaner deal than trying to do that. Like the 60-40 rent credit, that's a dangerous territory, especially if you do them in volume. This is just a straight up lease equals the same as the 7% would have on interest only, and I'll pay you $1 for the option because I know I'm just pissing money in the wind until I exercise my option and find an alternative financing.
Okay. I'm gonna listen to this recording. Did you guys say it's gonna be in the Facebook?
Yeah, so we've got in the new Facebook group. I don't know if you've joined it yet. I just set it up yesterday.
I did.
Okay, so yeah, we'll process the recording and drop it in there with this sheet as a download and all the show notes, all the other links we talked about.
And I see. Call number 1 was already posted from.
Yeah, I did that. I think this morning I put it in there for everybody on the call.
Yep. Super helpful. Thank you, guys.
Yep. All right. Does anyone else have anything pressing? It looks like we're 20 minutes past the hour. So if nobody has anything they have to deal with today, we'll wrap up and we'll be back here same time next week. We don't necessarily have an agenda set for next week. It may just be transaction engineering like this, or we may jump into something creative finance. Before we go, while you got still a lot of people here, is there anything you would like to learn from us? Anything that you feel like isn't being covered in other places you're getting content? I mean, we're talking about creative financing. We've touched on short sales. Like, what can we do for you guys? And Maria, I see your question. The name of the Facebook group is Market Makers Real Estate Mastermind, and there's a pinned link in the top of the chat from the beginning of this call.
Also, guys, you see on your screen here, if you want to download that tool, I'm eventually going to get the tutorial video up there, but I wanted to get this out there for you to download right away. Okay. You can go to the link I just put in the chat. It's also on your screen right here. Okay. So Chad, I'm going to be logging off. Yeah.
Ashley, if you can email that deal to me and we may highlight that next week, or actually, yeah. So it's Chad at shortsale.support. And John and I will dissect that and we'll put it on the table next week.
I just put your email in the chat. All right, guys.
Well,
Thanks for joining. We'll see you Wednesday.
Thank you. Thanks, guys.